All attendees are in listen-only mode.
So hopefully you guys can all see my screen. If you can, just say, just quickly yes would be great. Or Scott, if you want to just jump on and just tell me if you can see it or not.
Yeah, it looks great.
Okay, screen cursor, good. Okay, I just want to make sure. All righty. So we'll wait a couple minutes here, or one more minute, and then we'll get going. And Scott, thank you, by the way, for setting this up. Appreciate it.
Yeah, thank you, Chris. It's going to be good. It's always nice to have one of our partners as a guest. Should be good.
Absolutely. So I guess we'll kind of get going here. So guys, my name's Spartan. My real name's Chris. Everyone calls me Spartan. That's just kind of what I'd be known as in the trading community. What I am is an individual who started a trading, community trading room, I guess you could say, and we're focused on a few different things. Today, we're going to be going through finding the right ideas for you and your account. This is going to be bringing in the actual trade idea software. So basically what we'll talk about is when you see something on your scanner, how do you decide whether or not it's a good idea for you and your account? So there's a couple different things that I think about and that I go through from a not only technical standpoint, but from a, I guess, kind of mental and theoretical standpoint as well. So we'll touch upon that. So without further ado, we can kind of get started here. So again, finding the right ideas for you and your account. Just want to start off with a little bit of an introduction. Who I am, Spartan, technical trader, 7 years, going on 8 this February, full time, 10 hours a day. Now I'm probably doing about 12 to 15 hours a day in front of the screen. When I have a bunch of traders that rely on me and my information, I give them as much time as I possibly can, which is quite a bit. Spartan trading community is the community I've built. Two partners. I have two partners. Mama Options, which is her name's Beth, and South Beach Steve, both are institutional traders and fund managers, combined 79 years of experience. These individuals have not only survived in all types of markets, they've thrived. So, it's a pleasure to be accompanied by those two individuals. So we got a true team of professionals. What we're going to be talking about today is something that I think is extremely important. And the first thing we're going to talk about is risk reward. Now, risk reward is something that is talked about a lot in the trading community, but I don't think it's explained well. I think that if you can understand it well and you can develop criteria for yourself, you can start applying it to each situation that you see, and it can help tremendously remove a lot of emotion and help with profitability in the end as well. So we're going to talk about risk reward in your account. So why does it actually matter, how it works, etc. I'm going to be going through some examples, running it through a little simulation that I built a couple of years ago that I still use to explain it today. We're going to talk about building trade criteria for both equity and options. So using risk reward criteria, building it, and then applying it to your account for both. If you play stocks, we'll build it for that. If you play options, we'll build it for that. I'll probably ask, an individual in the room, or maybe I'll just do kind of a basic risk reward breakdown that I think can be applied to most accounts that are around that over the PDT rule. Lastly, we'll talk about using that criteria coupled with a scanner. So when you use the Trade Ideas software, which I think is fantastic, I use it every single day. Whether or not you're using it in the pre-market, intraday, you're using those channels. They have tons of different channels. They got the algorithms. They got if you're looking for stocks that are squeezing, momentum plays, low floats. You're looking at specific sectors. They do have scanners built for each part of the market that you can use and focus on. So it's going to be talking about looking at the scanner, seeing some sort of ticker flash up on it. How do you decide whether or not to trade that stock? There's tons of different things that are going to pop up on the scanner. It can be overwhelming if you don't develop some sort of criteria for weeding through things and basically deciding, okay, this one makes sense for me or this one doesn't make sense for me. So we'll talk about actually how to apply it and kind of the process there. So the first thing I want to talk about is risk reward in your account. So what is risk reward? What does it mean? Why is it important? So this spreadsheet here is a spreadsheet that I created years ago. And basically what this does is this runs through a year's worth of day trading, 5 trades per day. And what it talks about and what it shows you is how important this ratio is. Now, the thing to note in this simulation is it's 5 trades per day. The probability of these trades working is completely random. So the probability of success is random. The only variable that's being controlled is actually the risk and reward. Risk reward, what it represents is the amount of downside you're willing to risk and the amount of upside you're trying to make per trade. You're not always going to risk the entire amount of downside. You're not always going to try, you're not always realistically going to make the amount of upside each trade. But it's a way of placing yourself in opportunities by looking at support and resistance areas, whether or not if you're going long or short, to make sure that you're placing yourself in an opportunity that has the potential to make, whatever your profit goal is per trade. So I want you to focus on a few areas here, and I'm just gonna get my annotations up here. I want you to focus on up here, which is the max loss, and this, I'm gonna just change this to say minimum profit per trade. So these two areas here, and I want you to focus on the risk reward ratio itself. These numbers themselves is just the simulation running in the background. It's running across multiple spreadsheets. And then I want you to look at the yearly profit, because these are the most important factors. Let's decrease the size to something, which may be a little bit better fitting for people's accounts. So let's say you're risking, $100 to make $100. I'm risking 100 to make $100. Risk reward ratio of 1. Random probability of these trades working. So 50-50 shot, let's just say that. With commissions, you can see that, the yearly profit, you're going to be negative for the most part. Commissions is something that would have to be added into this. This is just running without that factored in. But you can see that the profit is minuscule, tiny. Once you start skewing this ratio a little bit in your favor, now let's say you're risking $150. So you're risking 100 shares on 1 point, risking 1 point to the downside to make, let's say, $1.50 to the upside, and you're doing this consistently. So now you just skewed the risk reward ratio just a little bit in your favor. So now we're talking 1.5 over 1. Just by skewing it a little bit in your favor, random probability of these trades working, your yearly profit will be consistently profitable. Now, again, this is just a simulation running, and it's to show you how important this ratio can be. If you're constantly placing yourself in opportunities where you're controlling discipline and you're controlling, this is my max risk, this is what I'm willing to risk, and that's it, and you're always making sure that it does have enough upside, let's say on a long idea or long setup, to make your goal. You do that consistently over the course of time, you can get profitable even at random probabilities of being correct. Of course, we shouldn't have random probabilities in trading. We should base whatever we're doing off of a past system, which, we record whether or not these things are working or not to get the actual probabilities of those setups. And then you'll obviously eliminate things that would be under, I would say, 70% correct. But this just kind of shows you how important that ratio is. I always say, you probably want a 3-to-1 risk reward ratio minimum. So let's say, just for instance, let's look at a stock, and let's say I have, 300 shares of the stock. I'm risking 1 point. So I'm risking 1 point on 300 shares. So this will be negative R, which is -1. And I'm trying to make 3R, which is a 3-time reward to the upside. One of the things to note is when the simulation runs is it's not always hitting the max profit or the max loss. It's actually it's randomizing the numbers within that range, and it's to make it more realistic. Because a lot of the times you're going to see a chart that has, if you're playing 100 shares, you want to see 3 points of room to the upside. So, for instance, let's say, I don't know, it's a bigger stock like Netflix. You want to see 3 points of room to the upside, and you're willing to risk 1 point to make that 3 points. Let's say you see a flag setup, which is, a basic flag pattern like that. If you're unfamiliar, there's a lot of great information. You can just Google what a general flag pattern looks like, and it will come up. So let's say, you're just trying to take that flag pattern long when it breaks out, and you're looking for the next resistance point to the upside. If you make sure that it has, at least 3 points of room to the upside, you always know what your risk is going to be. It's going to be that 1 point. This is actually, a good trade for you and your criteria. Now, I can't decide what risk reward ratio makes sense for you. I think 3-to-1 or higher is the best to go, because when you do start trading, you're going to be able to lock in, higher amounts of gains. One thing to note, though, is there's always, there's two sides to that risk reward ratio that come from a mental point of view. And it's, the risk side, which is actually being disciplined and controlling the risk, setting stops, making sure you're never going over your max stop, making sure you're not averaging down and increasing the loss amount when you are wrong. And when you are right, it's allowing these things to run into your profit target or allowing them to run as long as that trend is holding. Obviously, the trend breaks, you want to exit that position. But it's making sure that you do have that sort of conviction to hold the stock long in order for it to get closer or through that profit target. If you're one of those traders that theoretically sets up a risk reward, but they always end up cutting off their winners, around, let's say, 1, and they're always letting their losers go hit their stop, they're not cutting them off even though they're breaking the trend, then your actual risk reward ratio would become 1-to-1. Even though your theoretical and what you're looking for is 3-to-1, what you're doing is a 1-to-1 because you're not letting these things run and you're letting these things go to your stop. What do we know about a 1-to-1 risk reward ratio? You repeat that over the course of time, you're probably not going to be profitable unless you have a very high probability of being correct. The best thing and the biggest thing in trading is the actual ratios and placing yourself in opportunities. That's really the only thing that we can control, is where we place ourselves. We can't control the outcome of a trade. We can base it off of past probabilities, but that really doesn't matter because we have no control over it. This we do, and I think it's very important to be skewing these situations in our favor every step of the way. By using a scanner like Trade Ideas, you get a lot of ideas coming at you. You got to be able to apply this in practice. So there's a little bit of planning that goes involved before you actually start applying this. You got to decide, okay, based off of my parameters, based off of the risk reward that makes sense for me, this is what that looks like on paper. And then when you see an idea, let's say, I don't know, something like, Facebook pops up on the scanner, for instance, on a bigger cap scanner. You look at the trade and you go, okay, things breaking the high, let's say it's just a high of the day break scanner, and you're looking to see where it has room to, that's how you can decide, okay, if it has the enough amount of room based off of that price target or based off of the price that it's currently at to get to my reward, then it makes sense to take the trade. So, I just wanted to explain really basically and really basic, like kind of layman terms, what risk reward is and why it's important. And then I want to talk about and, build a little bit about or build some sort of examples for you guys in your accounts. Lastly, the one thing that I do want to touch upon is the nice thing about creating this sort of criteria for yourself and understanding why these ratios are so important is you can increase basically mathematically your chance of being profitable first and foremost, which is obviously one of the most important things in trading that we care about. And the second thing is you're going to be able to decrease emotion. This makes trading a little bit more robotic in the sense that you have a fixed amount you're willing to risk every single sort of trade, and you cannot, basically steer away from that. You have to decide, this is my criteria, and stick to it. And once you do, you're going to reduce hesitation getting into positions. You're going to have higher conviction because you know how important it is to hold these things longer, to let the ratio, let the stock run into the price targets, etc. I've had a lot of traders in the past that once they started to apply this, they saw massive increases on their bottom line. And they should, because this is, the discipline and the conviction that traders do need in trading. Every single professional trader does some form of this. I can guarantee you that. It may not be, this exact way of doing it, but they're doing some form of this. And I think it's just extremely important to be controlling it. Again, it's talked about a lot, but I don't think it's explained as in depth. In some situations it may be, but I just wanted to go over that for you guys just to start off, because this is going to come in when we start talking about the actual scanner and looking to see whether or not these things make sense. So risk reward, what does it mean? We kind of went through that. So mathematically, like I said, increases your chance of profitability, and mentally, this is what, can help decrease emotions, etc. in trading, which obviously is the biggest factor, I believe, in performance. So let's talk about building the actual criteria. So we went to the spreadsheet and we talked about, how it works, the simulation, etc. Let's talk about applying it. So it's great. I understand how risk reward works. You guys get it. If there's any questions on how it works, just let me know and I can kind of go back and we can answer those. But let's talk about, how do we apply this to our account? So we got to decide, based off of our account. Let's say, you have a $25,000 account, and let's say we're talking you're playing equity or stock. How much are you willing to put in per trade? So let's just do kind of a basic, I think probably realistic for a lot of people could apply it. Let's say that you're willing to make, you want to make $300 per trade. This is a realistic number for you, and you're willing to risk $100 to make that $300 per trade. And you're willing to do this over and over and over again. That negative $100 is an amount where if you do get stopped out and you lose that $100, it's not big enough for you to get emotional. You're going to be able to come back and, trade again without, you're going to go, okay, I lost $100, but not a big deal. That loss amount has to be a small enough amount where you don't care. Obviously you care if you lose, but it can't affect you that big emotionally. If it still does, then that number is too big. The great thing about trading is once you get consistent, on smaller numbers. You're risking $50 to make 150 or whatever that number is. Once you get consistent doing that, you can slowly increase that number. Get consistent with the new amount and then slowly increase it again, get consistent with that amount. And that's how, traders go from small to big over the course of time. It doesn't happen overnight, but that's kind of the way that you do it. So let's say, you're risking $100 to make 300. Your account size is 25K, but your max, dollar amount you're willing to put in per trade, I don't know, let's say it's up to, for this example, $15,000 is the max amount you're willing to put in per day trade. So, and if you're swing trading, it's probably going to be a smaller number so that you can kind of reduce risk overnight, or maybe you're going to be hedging with options. I don't know, but we'll talk about that in a little bit here. So let's say, 100, risk 100 to make 300, max dollar amount per trade for intraday day trading, $15,000. This is how I can apply this to your guys' account or someone's account. So let's say, you're starting off, I'll just quickly build this. 500, let's do that. Oops. Pull that down. Oops. Sorry guys, one sec. There we go. Let's go up to 15,000. Okay, good. So at the bottom of this page, there's a couple different areas, and I'm going to zoom up on this so that we can see it a little bit better. Yeah, it should be pretty clear on your guys' screens. So we got the max loss profit, and then we have the dollar amount that you're willing to put in per trade. Because you're willing to put in up to $15,000 per trade, you're not going to do that on a $1 stock, 5, 10. You're going to put in smaller amounts so that you can manage it with actual stop losses that give the stock a little bit of room. One of the things that I always talk to the traders in my room, or just traders in general, if they ever have questions, is it's really important when you are trading to have a scale size. And the whole reason with having a scale size, why it's so important, is if you take full size out the gate, and let's say, you see your risk reward ratio is 3-to-1, you see the flag break, you take it long full size, and let's say you have, let's say it's, I don't know, a $10 stock. So you take 400 shares right out the gate, and right away it comes back and retests the flag support, or retests some EMA support, I don't know, down there, and it's over your 25-cent loss amount. So right away you get stopped out for $100, and then it bounces off that area and continues to go higher. The biggest reason for having a starter size, in this case, your starter size, I go by quarters. This is just the easiest way to do it. Your full size is 400. Your starter size would be 100, or your scale size is 100. The biggest reason for that is if you get into this trade, and let's say, your risk reward. So what do you need to see to the upside on this? 75 cents. So let's say you see $1.50 of room to the upside on this $10 stock. If you get in with your starter size of 100 shares, you can risk up to 1 point rather than just 25 cents until you hit your max loss amount. So by scaling in, you can give it a little bit more time to breathe. Once it starts working, you can reevaluate. Let's say it starts to get into an uptrend after it breaks that area. If you want to add your full size, the first thing that you would have to do though is check again, how much room does the stock have to the upside? Does it at least have my minimum profit target of 75 cents? If it does, fantastic, it meets your criteria. You add your full size and you take, and you lean into the trade longer. One thing that a lot of traders, may not realize is, and this has to do with scaling and why it's important, is if you are always taking full size out the gate, or if you're averaging into losers, you're actually adding into a situation where you're wrong. I think averaging down is a terrible way to be trading, just because if you're wrong, sometimes you can become really wrong and you can lose a lot of money. Typically, you're going to go over your max loss amount as well. You can always get in lower in a trade, right? And when you're right, you're leaning into your winners. It's proven. You have a proven thesis of being correct. It's like, I always say this is a pretty good analogy for it. If you're in the casino, you're playing blackjack, you have a really good hand, and you have the opportunity to raise your bet. Let's say it's a straight, it's a royal straight flush, and you have the opportunity to raise your bet. Are you going to raise your bet? Most likely. It's like being in a correct trade. When you're in a correct trade, you're proven to be right. So why wouldn't you add into that position? When you're wrong, let's say you have a bad hand at poker, you're not going to add into that position. Why would you? You're wrong. So that's my whole, reasoning behind scaling, and mathematically it just makes sense to approach it that way. So that's why I recommend doing it. Anyways, going back to the spreadsheet, let's kind of talk about what you see here. So we got the max dollar amount and max share size per trade. We got the scale size based off of the dollar amount you're willing to put in per trade. Stop on the scale size. Scale size profit I wouldn't worry about. Don't worry about this area here. Stop on your full size. So obviously if you take, $10 stock again, 400 shares, where does your stop go? Your stop would go 25 cents below your average. And then profit target. So the most important thing on this criteria, once you've developed it for yourself, is to print it out and then to be recognizing these two things and applying these two things. The first biggest part is this profit target area. You need to know how much room you need to see on the chart to the upside. And we'll talk a little bit about how to recognize upside or downside. In this case, we'll just keep it very simple and talk about recognizing upside on a chart. So we need to see this amount of room on the stock to the upside in order to meet our minimum profit target of 300 bucks. So this is the first thing to applying risk reward. So you would spot, something on the scanner, bring it up, you look at the setup. This is what you would look at. Does this stock have enough room for me to meet my goal? If it does, it's a good trade. The criteria is good. You obviously have to agree that you like the setup as well. If those two things are good and they're in check, take the start on it. Don't hesitate. Take the starter size, start to work, add into it if it does. If you do get stopped out, not a big deal. You're just getting stopped out for your max loss amount. The criteria on the trade was good. Are they all going to work? No. Trading is not just about winning. It's about understanding how to lose and lose correctly, because you're going to lose in trading. You're never going to be correct 100% of the time. It just doesn't happen. And applying this over and over and over again over the course of time. This is what will lead to profitability. This and, a decent system with, a decent probability of being correct. But if you always are skewing these ratios in your favor and you're always applying them, you're going to see, a very big increase in your bottom line. A good way to kind of see this in practice is go through all of your trades for 2018. And once you've decided what your actual risk reward ratio criteria would look like, go with all of your past trades, anything that is lower than your max loss, make it your max loss amount. And then see how big of an impact that has on your P&L. It's probably going to be fairly substantial unless you're controlling risk already. So important thing, and it's a good basically way to kind of see this in practice. I live and breathe this every single day. So, it's important to be applying this. So this is how you would apply it on the equity side. If you're playing options, it's similar in terms of options, but there's, we got to do one extra thing, and it's, looking at the delta of the contract. So let's say, $25,000 account, you're playing options. You're probably going to be putting it like this, this is a little bit too 5,000 max. Let's go smaller than that. 2,500 bucks. And this, this would be again for day trading. I think you probably wouldn't want to go over this. Actually, let's make it 1,500 bucks on swing trading options, especially in this market. It's a little bit too choppy. You're probably go over your max loss amounts. So if you're day trading options, let's say, you're playing the SPY, short, that's kind of the opportunities that I've been setting up lately. You're looking at some contracts that are out of the money. Let's say they're worth $1. You want to put 500 bucks in, so you got 5, contracts max. Some, it depends if you want to scale in or not on the option side. I think it's okay to go by half. Take 2 contracts and add the 3 or whatever you want to do. Some of the cheaper contracts, or if they're fast moving, it's going to be harder to scale in. So you kind of got to decide if you are or you're not. And if you aren't, then you probably just reduce your size overall and risk a little bit more. So contracts, let's say you're playing SPY. SPY's breaking down. You look at the SPY puts, out of the money contracts. The SPY has, I don't know, in this case, it's a $1 contract. The delta on that contract is, let's say, 35 cents. SPY has $2.30 a room to the downside, or let's go $2.50 a room to the downside, just to make it easy. Same sort of concept, except when you look at your profit target, which is how much room the contract actually has to have in order for you to meet your goal of that 300 bucks. You could just got to look at the delta of that contract. So let's say the delta in this case on that $1 contract is, I don't know, let's say it's 30 cents to make it easy. So the delta is 30 cents. The underlying asset has 2.5 points of room to the downside. Really quickly, 2.5 times 30 cents equals 70 cents or 75 cents. So does the contract have enough room for you to meet your profit target goal? Yes, it's got more than enough. And obviously, we all know that if you're an options player, you would know this. Obviously, as the contract moves closer towards the strike price, the delta is going to increase. So, that's something to also think about. But this is a way of quantifying whether or not that option contract that you're trading makes sense. So the same thing, I use the options scanner on Trade Ideas. Basically, it tells you when there's a ton of volume coming in, some calls or puts. I use the basic somebody knows something or just large amounts of volume, because you do want to follow the volume in the options. People tend to, we always say, they tend to know something, or they tend to have done some sort of due diligence and know something that the street may not know. So it's important to follow that big money flow. Use the scanner, bring it up, look at the contracts, look at how much room the underlying asset has, decide based off of the deltas whether or not you want to take the trade and it makes sense for you. So that's kind of the risk reward in practice. This is a spreadsheet that it's fairly basic. I mean, what we're looking at is based off of your profit goals and your loss amount. You can figure out fairly easily based off of your size, how much to risk. It's basic multiplication, figuring out these ratios. So it's something that you could do on your own. And if you can't do it on your own, just reach out to me. I can help you, set it up or, even build one for you. So that's the, the risk reward that I wanted to go through here. Now I want to go back to that PowerPoint. Let's see here. Reps right there. Go back to that PowerPoint and just kind of recap here. So building that trade criteria. So use the criteria, print it off, make it tangible. I think it's really important that once you develop that criteria to actually make it tangible in terms of having a hard copy in front of you and a calculator as well. Because stock's not just going to be 10 bucks. It's going to be like 10.27 or whatever, and quickly be able to calculate it. But make it tangible, make it a rule to apply. So when you don't apply it, you got to have some sort of punishment for yourself, shut off your platform, whatever it is. But you have to have it in front of you. And I think making it tangible, you can hold yourself a little bit more accountable. You should feel bad about not applying rules in trading. And the rules are really important to have, obviously, because you can reduce emotion, etc. So applying it in practice, like I said, we're going to go through that now, kind of the process of, bringing up the scanner and kind of going through something. So let's bring up the actual Trade Ideas scanner here. And so let's go just the channel bar we can bring up, and let's just look at, I don't know, let's go to a sector maybe. Volume. So obviously there's gonna be nothing today because the market was closed. Let's go through the actually AI. Maybe there can be some stuff from the last days there. Okay, so let's say, this is what you have the scanner up. There would be an idea there from one of the past days, whether you're not using the, Holly Neo, the Holy Grail, or one of the sectors, you're going to see some sort of ticker pop up. Or maybe you've just built a custom scanner for yourself as well. Some sort of idea is going to pop up on that scanner. Let's say, I don't know, we'll quickly flip through maybe the Fang or something like that. So let's say that you see, I don't know, something like, and this could be a good example. We can look at this VEEV here. Let's see the VEEV pops up and the scanner is a breakdown, like going through the lows scanner to the downside. I'm just going to move this down there so you can see. FYI, guys, this is a 10-minute chart. I use 10-minute charts for intraday trading. So scanner, you bring it up and you're breaking the lows on the chart. You got to decide based off of your criteria whether or not this thing makes sense to trade. So VEEV, $92 stock. Let's take a look at the criteria that we have here on it. So 92 bucks. I'm just going to make this 92 just to match it. So the first thing that we got to check, okay, so we brought up the scanner. We have the idea. Now we got to look at the profit target. So this is going to be a short trade to the downside because it's breaking the lows. We got to look at this. Does it have at least $1.84 room to the downside so we can meet our profit target given our max share size on the stock? So does this thing have $1.83 room to the downside? So there's different ways of figuring out whether or not a stock has the amount of room you need. One of the things that I do is, let's talk a very basic way of figuring out upside and downside targets, is you can go back, 5 days to 10 days just on the intraday chart and look at the ranges. Stock trades between highs and lows. So a range is a high and a low. In this case, I would go back and I would look for the closest range to the current price where it's breaking down from. So it's breaking down at, let's just say 96 bucks right there. Where's the closest range or the closest support level that this stock has room to in the past 5 days? So really easily you can pull the chart and look where the past 5 days low is, and you can go, okay, stock has room to $94.28 of room to the downside until it hits the next support level. The only thing that I know is the stock has room down to this level. I don't know if it's going to hold the level and bounce off of it. I don't even know if it's going to get there. I know there's a higher probability though that once the, this support area breaks, it's going to have room down to this area, that low. So we're at 96 bucks. We got room down to 94.28. Does the stock have enough room does the stock have enough room to the downside? So we got $1.72 of room to the downside. Again, we bring up our risk reward and we check. Okay, so we need $1.84. Unfortunately, no, this idea doesn't make sense because there's no way for us to meet our max profit goal. So we just weeded out a stock. This one did end up going through that level and then going, through the next level as well. There's no way to know that that's going to occur, but the first thing that we got to check is if the stock has more room or enough room to that level, there's a fairly decent probability it's going to hit that target. And that's what we want to make sure. We're placing ourselves in opportunities where we do have enough room. We're not just going, well, this one might make sense or this one doesn't make sense. So let's look at another goal and we can look, or another trade, and we can go through, I don't know, let's take something like OKTA, because this one usually has a lot of volume or a lot of volatility. Same concept. $63 stock, it's breaking the lows. We bring up the low of the day break scanner. You can kind of see where the next support is, which is at the last day's low, 92.55. So 93.46 to 92, 93.46 to 92.55. So about what, 90 or 89 cents a room ish to the downside. Again, bring up the chart. Does this thing have enough room? No, we need $1.20 of room to the downside. Doesn't meet the criteria, so you skip it. Let's try and find something that does meet the criteria. This is a good way though of weeding through stocks. You're not going to take everything off the scanner, and this is the reason why. So OSTK, let's take a look at this one. And let's say, you were looking at the scanner, and let's say it's like an EMA cross, crossing the, I don't know, 20 SMA or something like that to the downside. So EMA SMA cross to the downside. And let's say up here, when this trend broke, it started to cross that 20 SMA to the downside from 1980. So 1980, we know where the next low is. It's that support level at $19 down there. Bring up the, your risk reward you have in front of you. Let's just make this an $18 or $19 stock. I'm just going to increase this just to make this example work. So you need 57 cents of room to the downside. Stocks breaking, let's go zoom up a little bit. Stocks breaking, let's say, the 20 SMA, maybe that's the scanner that you're looking at. Breaking that area to the downside, the closest low on the next day is that $19 mark, closest support level. You have, from 19, let's say 1980, just to make it flat, to $19, 80 cents of room to the downside. You need 57 cents of room for this to make sense. You take the trade, it starts working. You look to add into the position as it's working. And now you're full size, and then you just let it, fade, hold it as long as that trend's holding to the downside. And then obviously once that trend breaks, you would exit the position. So it goes into the target and then you exit it and it starts bouncing. So when you're able to apply this with a tool like Trade Ideas, you're able to very quickly figure out, okay, this idea is a good idea or a bad idea. You're able to weed through a lot of the ideas. There's a ton of noise in trading. This doesn't just apply to scanners. I mean, scanners are fantastic for developing ideas and it does a lot of the work for you, but you can apply it to news wires as well. Let's say news comes out on something, same thing, apply that risk reward criteria. Or let's say you're even in a chat room. I always tell traders, they need their own risk reward criteria, even in our chat room. Even though I'm giving them really good ideas, I'm going to give them high risk reward ratios because I think most of the ideas I can give can meet people's goals, but they still have to have some sort of criteria and make sure that whatever idea they're looking at makes sense for them. And if it does, then they take the trade. So always two sides of it, setup and then risk reward. And again, that Trade Ideas, software is fantastic because it can do a lot of the work for you. You can do it on the option side, equity side. You would do the same thing on the option side, for instance, on SPY. Like Tuesday, you can see all my support and resistance lines. Let's just do this and hide the drawings. Same thing when SPY, maybe you're looking at a lot of put volume coming in on the SPY ETF because there was a ton of put buying out of the money before it did break down on Friday. You brought up the option scanner. You saw that ton of volume going into the puts. You looked at the SPY and it's at 276.50. It had room, I think, to 274.30, just going off memory. You look at the SPY 275 puts or 276 puts. They cost X dollar amount. You apply the exact same concept, but you just bring in that delta. So, stock has $1.70 based off of the amount of room it has, and the delta, does this make sense to buy those contracts? Yes, it does. Take the puts. So it can be applied both on the equity and option side, and it's important to do some form of this. At some point, it's going to be slower to apply. So in the mornings, it's hard to apply because it's so fast. In the afternoons, that's when I would recommend starting to apply it, using those scanners, and then starting to weed things in and out. Over the course of time, you're going to get very fast at it. It's going to become automatic. You're not going to be needing to check your little criteria all the time or automatically. You're just going to kind of know. I always keep a calculator in front of me just in case I need to quickly calculate something, but usually it's fairly easy to figure out quickly. But once you start applying it again, guys, the whole reason behind it is you want to be disciplined. You want to make sure that you're skewing opportunities in your favor. It's a very systematic way of trading, and I think the best traders are all systematic. They control the situations that they're in, because really this is the only way that we can control things. So, I recommend definitely, applying some form of it. Let's kind of go back to the PowerPoint there. So let's kind of just run through again really quickly the decision process. So number one, idea spotted. So using your scanner, spot an idea. Then what do? You bring up the chart. You bring up the daily, you bring up the hourly, you bring up somewhere where you can see those past support and resistance levels, and whether or not you're going long or short. The examples we talked about were short setups, which I think is fitting for the market lately. Bring up the chart. Does the setup look okay? does it have enough room? Does the the risk reward make sense or not? Is it a setup that you like to play? There are setups that people do like to play. There's setups that people don't like to play. Some people like to play, bear flags or range breaks to the downside or whatever. Some people don't like to play them. Decide whether or not that's something you like to play. Check the support or resistance levels, like I said, and then evaluate your criteria. Does it have enough room? Does it not have enough room? It does or it doesn't. If it does, obviously you can take the trade, decide to. Don't hesitate, just grab it. If it doesn't, don't take the trade. Only thing is, when you do take the trade, scale in. Decision, like I said, decision process is fairly quick once you've determined all this stuff, and once you start repeating it, it becomes habitual. Take the trade or don't, and then if you don't, there's no issues with that. You just keep reviewing your scanner. Is there a little bit more work involved with it? Yeah, but it's not that big of a deal, and it can make such a big impact. It's definitely worth looking to apply it. So that's basically what I wanted to go through today, guys. Not a ton of. I didn't want to get too in depth with it, but I thought what we did go over can help you guys, especially in this market where I think the importance of controlling risk is huge, because it is a choppier market than it has been in a few years. If you're day trading, you definitely got to apply it. If you're swing trading, it's going to be a little bit harder to apply. I think the swing trading market right now, you have to manage the risk actively. So you can't just buy things and set stops, or short things and set stops. You kind of got to be moving those stops up, putting them in the money when you're in the money, etc. So really important to be applying these parameters in today's market. So that's what I wanted to talk to you guys about today. Just wanted to give you guys, again, a quick overview, kind of who we are. Again, Spartan Trading Community, SpartanTrading.com is the community that I built. We do day trading, we do swing trading, stocks and options, small to large cap. The market itself right now is being more of the opportunities are more on the larger cap, ETF, the FANG, and some mid-cap stocks intraday. I find that's the best opportunities. Small caps haven't really been running that much lately, so I kind of avoid them anyways. We have both text and Zoom in terms of streaming. So we got text chat that's open 24/7, always answering questions. Zoom, which we use for streaming audio and video. People can see my screen and the other moderators all day. We go through multiple ideas, charts, options, and equity. Give our what do we see in terms of the setup? Where's the room? We break down the risk reward as well. Do a lot of guidance and explanations real time. Reinforcement over the phone and Discord. So if you are having issues, we like to talk to traders, etc. Get to the bottom of the issue. I find that 10-minute conversations, very short, but can have a very big impact on someone's trading if you can basically address the issue right away. And if you can't fix it, then you can talk again in a day's time and take the Kaizen approach to improving. That's, I think, the best way to take the approaches in trading when you're kind of breaking habits or habitual patterns. So accountability, all trades are written in text to keep track. Team of pros, technical, option, macro experts. So we got some good individuals in the room that are helping me run it. I'm a technical trader myself, so everything that I'm doing is very support, resistance, trend lines, EMAs. That's what I'm looking at. We got Beth and South Beach, which are macro experts, which is fantastic because they can tell you, based off of the news that's going on, the macro environment, what they see and what they can determine to be happening in the near future. So again, SpartanTrading.com. If you guys are interested, I did put together two, 50% off promos, trade ideas, 50 live. I can post this in the chat, or you guys can just take a screenshot of this for later. I'll just take a screenshot, or I'll just post these right now. Hopefully that copied. That's the first one, and then the second one. You would just copy and paste those into the actual chat itself. Spartan Trading, at Spartan Trading is my Twitter. If you guys got questions, I'm answering, talking to people all the time, direct message, give free ideas, etc. like that, all the time on Twitter. Sometimes I'll walk down the SPY like I did yesterday on the puts, or if you're just shorting or buying, let's say volatility, VIX, UVXY, whatever. Trade Ideas. If you guys want to use the Trade Ideas software, which I do highly recommend, you can go through me, Spartan 15. You get 15% off. Fantastic software. I think there's no better software for scanning the pre-market, figuring out what's gapping up and gapping down to prepare yourself for the day, using the scanner intraday to find things that are moving on the, with high volume, which I think is very important, especially if you're going to be day trading, both on the equity and option side. So definitely give it a look. And lastly, their scanner after hours there's nothing better than the Trade Ideas software in terms of scanning. I think, I've been using it for almost 4 years now, 3.5 years. It would be going on 4 years in the summer. I don't plan on ever switching from their software, so I'm happy to partner with them. I think they're fantastic. Anyways, I just wanted to end it off there, guys. Thank you. I know it's a day off, and I thank you for coming in. If you didn't, thanks for watching the recording. If you guys do have any questions right now, I'll stick around. We'll answer some questions for about 10 minutes. I'm going to end the recording off here, and we'll kind of answer some questions, whether or not it's about the risk reward or the scanning software.